Devina's two portfolios, which look at domestic equities, of course, she invests globally as well, have outperformed everybody and anybody in the market. The year to date performance of IS 50, which is the pure equity portfolio, and another portfolio which has an overlay of gilt as well as gold, has been phenomenal in the first 6 months of calendar 2023. Devina, at this level, where do you see value? Most of these sectors that you and I used to track in the days gone by, whether it's auto, whether it's infrastructure, whether it's the old favorite FMCG, are already trading at record prices, if not record valuations. Where are you putting in fresh money?
Actually, I mean, we look at everything from base zero every quarter. So we look at it as if we had fresh money every quarter, uh, untainted by what we actually hold, because that's the only right way to do things. And we still are most overweight in capital goods and industrial machinery, which is something people have started to talk about in the last few months. But we have been overweight that sector since October of 2021, so getting close to 2 years now. And each quarter we assess whether that run is over. Till now, our systems have not signaled that that run is over. Banking is something that we did not like in 2020, we did not like in 2021. Middle of 2022, we went to about market weight in banks, which is now a little overweight. We still do not hold the non-bank lenders in any meaningful proportion. What we have added earlier in this year have been some auto components, some pharma, couple of construction companies. And of course, not everything is sectoral. So if I look at 2022, among our top five performing stocks would be ITC and Raymond. And both of those were not sector calls. But broadly, if you look at the sectors, this is what we like. And we are always very diversified, both in terms of number of companies as well as the sectors.
Okay, we'll dig into both these portfolios a little later, and I'd just like to put on record that for the first 6 months, which ended on June 30th, the two portfolios that Devina manages have outperformed both the Nifty as also by their peers very handsomely. So it's a 10.5% gain on First Global IS 50 in the past 6 months, compared with the 6.5% index appreciation that you've seen, and the First Global IMAAP, which has an overlay of a lot of gilt as well as gold, is still up 9.5%. Devina, as I was trawling through your portfolio, amongst the top 10 odd stocks, you have three IT companies, of course, two very well known, Infosys as well as TCS, and one mid cap that has done wonders, which is Nucleus Software. Overall, the software sector hasn't done much. The index just up about 2% year to date. What do you think is going wrong? Do we have to wait much longer, or is the Indian software story now getting a little jaded?
Actually, Shail, the thing is this, that if you looked at it last year, first half also, IT did not do very well, IT services. And at that time, the logic for it not doing well was supposed to be that the whole world is digitizing and there is so much demand for people with technology backgrounds that they will not get enough employees. The employees will be too expensive and therefore costs will go up and margins will get squeezed. This year, the story is supposed to be something the entirely opposite. If you go to the base of it, saying that there will not be demand. So, both cannot be true. So I think, this is a little overdone, because what had happened was that there was a slowdown in some of the Western economies. So what happens is that the orders you're supposed to get this quarter get pushed and may go on to the next quarter. But it is not as if that fundamentally something has gone totally wrong with the industry and it will never revive, because the whole move towards even non-technology companies becoming more digital, more technology oriented is not going to go away. So we are not super bullish on the sector, but we are still slightly overweight on the sector.
If you like the video, do like, comment, share and subscribe.